In the 1970s, banks had a simple rule. If you looked too risky, you didn't get a loan. But one man built a fortune by doing the exact opposite. He deliberately searched for people banks had rejected, people everyone else thought were terrible borrowers. And the strangest part? Some of those bad loans made him incredibly rich. But how could lending money to people nobody trusted possibly work? The answer comes down to one unusual rule he followed, and I'll reveal it at the end. His name was Arthur Williams, a little-known private lender who operated in the American Midwest. He wasn't competing with banks. He was looking for the borrowers banks didn't want. A small business owner with poor credit, a factory worker who needed emergency cash, an entrepreneur whose company was young and had almost no financial history. To a traditional bank, these people looked dangerous. But Arthur noticed something the banks were missing. Risk wasn't always the same as irresponsibility. Someone could have a bad credit score because they had failed once, but that didn't necessarily mean they would fail again. So instead of asking only, "What's your credit score?" Arthur asked a much more interesting question. Why did you fail? One borrower came to him after being rejected by multiple lenders. His business was struggling. On paper, he looked like exactly the kind of person Arthur should avoid. But Arthur visited the business himself. He looked at the equipment. He spoke to the employees. He studied the customers. And he discovered something the credit report couldn't show. The business wasn't fundamentally broken. The owner had simply run out of cash at the worst possible moment. So Arthur lent him money. And when the business recovered, Arthur didn't just get his money back. He earned a return that a normal bank loan wouldn't have given him. That was the moment the strategy became clear. Arthur wasn't actually betting on people. He was betting on situations. He looked for borrowers who appeared risky because of temporary problems, not borrowers whose entire business model was broken. That distinction changed everything. Because when banks rejected someone, competition disappeared. And when competition disappeared, Arthur could negotiate better terms. Higher interest, more security, more control. The very thing everyone else considered dangerous became his advantage. But there was still one rule that protected him from losing everything. Arthur never asked, "Can this person pay me back?" He asked, "If they don't, what do I have?" Every loan needed a realistic way out: collateral, a valuable asset, a reliable cash flow, or a business that could be sold if everything went wrong. He wasn't trying to predict the future. He was making sure the worst-case scenario wouldn't destroy him. And that's the real lesson. Fortunes aren't always made by taking the biggest risks. Sometimes they're made by finding the risks everyone else misunderstood and making sure you can survive if you're wrong.